We have a quick question here from Gavin, who asks about order fills and says that with where we are right now in terms of the Brexit negotiations, we've entered into a very bumpy phase. And he wants to know that if we do get a no deal scenario over the weekend, that will most likely, of course, lead to a huge one-way sell in the pound. And if everybody is selling the pound at that time, how are we ever going to get a good enough fill on any orders that we take to the downside? And I think this applies not only to this upcoming Brexit saga we have, but to any major, massive market moving events like this. So it's a great question, and there's a couple of important points to consider here. Getting a good fill on any order for that matter can be tricky when the market sees a huge influx of orders in a specific direction. Just think back to the huge flush we had to the downside in 2016 with the Brexit referendum. Now, what happens, of course, when we see things like that, those big shocks, we usually see a steady pickup in volatility as well, which means that your spreads from your broker will often get spiked. And don't get mad, for the broker for that. They do need to account for that increased volatility, just like we do as traders. So, to your question, I think the first part is important to talk about as well in terms of the market's reaction with a massive selling or buying move. When you are trading an instrument, that has very low market participation or very thin liquidity, think of some small cap stocks or maybe an ETF that isn't very well known, or a currency pair that has two highly volatile emerging market currencies paired together. When you have those types of instruments, getting filled on any type of orders in those types of environments is going to be difficult, as that spike in volatility and that one-way traffic means that there is much fewer liquidity to get any good fill, or to get a good fill at least. Now, when it comes to the spot FX market, that issue is drastically reduced and removed really to some extent, because the sheer volume of traders and trades at any given moment in the spot FX market means that there will almost always be enough liquidity for you as a retail trader to get a fill. Yes, the spread might be higher, but in an environment where it's something that causes the market to run 300 or 500 pips higher or lower, the spread really isn't going to be that much of an issue. Of course, if you are trading with a bad broker, an unscrupulous one, that might be a problem for you. But generally speaking, the liquidity should be more than enough for you to get a fill as a retail trader. And that's also where market making comes in. There's a big difference between institutional trading and retail trading. Everybody always slams on the market makers, and yes, some of them are going to be bad. Some of them do very unscrupulous business, but traders often dismiss one of the clear advantages of trading with a market maker broker, and that is that as a retail trader, if you are on a market making broker's B book, you will almost always they will almost always be willing to take any type of trade that you want to take on their books to make sure that the order gets executed if there isn't enough counter liquidity at that time. Remember that if you're a big institutional trader trading with those types of massive size of contracts, getting a fill in those types of environments is a real headache for them. But for retail traders, that problem is significantly reduced, because the size of our orders, even with large accounts, isn't even a drop in the bucket compared to the big guns out there. So, Gavin, I wouldn't really be too concerned about that, to be honest. If it's an event that is so big that the market keeps on dumping or ripping for hundreds of pips during that particular session, it really shouldn't be that big of a problem if you're trading with a retail account with a retail broker. If it's on the institutional side, of course, that's going to be a little bit more of a headache for you. But anything retail, as long as it's a reputable broker, getting filled on any types of orders really shouldn't be that much of a challenge. Obviously, it might be different if the market gaps open. So if, let's say, we get a no deal scenario and it plays out over a weekend where either one of the two sides walks away and says they don't want to continue with trade talks, then what you might get on Monday as the markets open, or Sunday evening, you might get that massive 200 pip gap to the downside. If that happens, I mean, you want to be very careful on just jumping in at the lows or at the highs, whichever way it goes. So that is something to consider, which is a challenge in terms of getting a good fill in terms of where the market opens. But if it's during normal market times, or during the week, or and something like that happens, getting filled, if you're trading with a reputable retail broker, shouldn't be that much of a concern, in my opinion, at least. I hope that helps with the question. And as always, any others, please don't hesitate to let us know.